Are you a new investor struggling to understand market capitalization and how it affects your investment choices? Let's dive into the world of market cap and unravel its mysteries together. When you're just starting out in the stock market, it can be overwhelming to navigate the various investment options available. One crucial concept that every investor should understand is market capitalization, often referred to as market cap. Market cap is a simple yet powerful tool that can help you make informed decisions about your investments and build a well-balanced portfolio. If you enjoy this video, please subscribe to my channel and press like button. So, what exactly is market capitalization? Simply put, it's the total value of a company's outstanding shares in the stock market. To calculate a company's market cap, you multiply the total number of outstanding shares by the current market price per share. Large cap, mid cap, small cap. The key differences you must know now. Let's break down the three main categories of market capitalization: large cap, mid cap, and small cap stocks. Large cap stocks, as the name suggests, are shares of companies with the highest market capitalizations. These are typically well-established, financially stable companies that have been around for a long time. Large cap stocks are generally considered to be those with a market cap of $10 billion or more. Some examples of large cap companies include household names like Apple, Microsoft, Amazon, and Google's parent company, Alphabet. These companies are often industry leaders and have a significant presence in their respective markets. Moving on to mid-cap stocks, these are shares of companies with market capitalizations typically ranging from $2 billion to $10 billion. Mid-cap companies are often in a stage of growth and expansion, making them an interesting option for investors looking for a balance between stability and growth potential. Mid-cap stocks can offer several advantages. Finally, let's talk about small-cap stocks. These are shares of companies with market capitalizations typically below $2 billion. Small-cap stocks are often associated with younger, less established companies that have significant growth potential. Investing in small-cap stocks can be exciting because these companies have the potential for rapid growth and substantial returns. If you invest in a small-cap company that becomes successful and grows into a larger company, you could see impressive gains on your investment. Start exploring different market cap categories today and see how they can fit into your investment strategy. With a balanced approach and continuous learning, you'll be well on your way to becoming a more confident and successful investor. Large cap stocks, why are they considered safe investments? Large cap stocks might be the solution you've been searching for. These stocks represent shares in well-established companies with a market capitalization of $10 billion or more. But what makes them such attractive options for investors seeking stability? First, let's understand what large cap stocks really are. These are shares of companies that are typically household names. Think Apple, Microsoft, or Johnson & Johnson. They're the giants of the business world, with proven track records and substantial resources at their disposal. One of the primary reasons large cap stocks are considered safe investments is their stability. These companies have weathered economic storms and emerged stronger. They've demonstrated their ability to adapt to changing market conditions and maintain profitability over time. This resilience provides a sense of security for investors, especially during uncertain economic periods. Another factor contributing to their safety is liquidity. Large cap stocks are traded frequently and in high volumes. This means you can buy or sell these stocks relatively easily without significantly impacting their price. For investors, this translates to the ability to exit positions quickly if needed, reducing the risk of being stuck with an investment you can't sell. Dividends are another attractive feature of many large cap stocks. These companies often have excess cash flow, which they return to shareholders in the form of regular dividend payments. For investors seeking steady income, particularly retirees, this can be a significant advantage. Large cap companies also tend to have diverse business operations. They often operate in multiple countries and across various sectors. This diversification helps protect them, and by extension, their investors, from localized economic downturns or industry-specific challenges. Moreover, large cap stocks typically receive extensive coverage from financial analysts. This means there's a wealth of information available about these companies, making it easier for investors to make informed decisions. The transparency and scrutiny these companies face can provide an additional layer of comfort for cautious investors. It's important to note that while large cap stocks are generally considered safer, they're not without risk. no investment is entirely risk-free. However, compared to smaller, less established companies, large caps tend to offer a more stable investment profile. One potential drawback of large cap stocks is their growth potential. Because these companies are already so large, it can be challenging for them to achieve the rapid growth rates that smaller companies might experience. This means that while your investment may be safer, it might not yield the explosive returns some investors hope for. Another consideration is that large cap stocks can be sensitive to broader market trends. When the overall market experiences a downturn, large caps often feel the impact. However, they typically recover more quickly than their smaller counterparts. For those new to investing, large cap stocks can be an excellent starting point. They offer a way to gain exposure to the stock market without taking on excessive risk. As you become more comfortable with investing, you might consider diversifying your portfolio with a mix of large, mid, and small cap stocks to balance safety and growth potential. It's also worth noting that many index funds and exchange-traded funds, ETFs, focus on large cap stocks. These investment vehicles allow you to gain exposure to a basket of large cap stocks, providing instant diversification and further reducing your risk. Remember, while large cap stocks can be a cornerstone of a stable investment strategy, it's always wise to do your own research and consult with a financial advisor. They can help you determine if large cap stocks align with your personal financial goals and risk tolerance. Mid-cap stocks, the balance between growth and stability. These companies, with market capitalizations typically between $2 billion and $10 billion, offer a unique blend of growth potential and established business models. Mid-cap stocks represent companies that have successfully navigated the challenging early stages of growth but haven't yet reached the behemoth status of large caps. They're like teenagers in the business world, full of energy and potential, but with enough experience to avoid rookie mistakes. Let's dive into why mid-cap stocks deserve a place in your investment portfolio. First, mid-cap stocks often provide a superior growth trajectory compared to their large-cap counterparts. These companies still have significant room for expansion, both in terms of market share and new markets. Take Etsy, for example. This e-commerce platform for handmade and vintage items started as a small startup and grew into a mid-cap powerhouse, revolutionizing the way artisans sell their products globally. Second, mid-cap stocks tend to be more stable than small caps. They've already proven their business models and have established customer bases. This reduces the risk of total failure that often plagues smaller companies. Consider Domino's Pizza. Once a mid-cap stock, it demonstrated remarkable stability and growth by embracing technology and improving its core product. Third, mid-cap stocks are often overlooked by large institutional investors and Wall Street analysts. This creates opportunities for individual investors to discover undervalued gems before they hit the mainstream radar. The reduced attention can lead to pricing inefficiencies that savvy investors can exploit. Fourth, mid-cap stocks provide excellent diversification benefits. They don't move in perfect sync with either small or large caps, helping to smooth out portfolio volatility. By including mid-caps, you're spreading your risk across different market segments. Let's look at a few more examples of successful mid-cap stocks. Teladoc Health, a telehealth services provider, saw explosive growth during the COVID-19 pandemic. It demonstrated how mid-cap companies can quickly adapt to changing market conditions and capitalize on emerging trends. Roku, the streaming platform company, disrupted the traditional TV industry as a mid-cap stock. It showcased how these companies can challenge established players and carve out significant market share in evolving industries. However, investing in mid-cap stocks isn't without risks. These companies can be more sensitive to economic downturns than their large-cap counterparts. They may also face challenges in scaling their operations or defending against larger competitors entering their markets. To mitigate these risks, it's crucial to conduct thorough research before investing. Look for mid-cap companies with strong balance sheets, consistent revenue growth, and competitive advantages in their respective industries. Pay attention to their management teams and corporate governance practices. One effective strategy for investing in mid-cap stocks is through index funds or ETFs that track mid-cap indices. This approach provides instant diversification across numerous mid-cap stocks, reducing the impact of any single company's performance on your portfolio. Alternatively, if you prefer a more hands-on approach, you can create a diversified portfolio of individual mid-cap stocks. This method allows you to select companies based on your own research and investment criteria. Remember, mid-cap stocks should be part of a well-balanced investment strategy. They complement large-cap stocks' stability and small-cap stocks' growth potential, creating a robust portfolio that can weather various market conditions. As with any investment, it's essential to align your mid-cap stock selections with your overall financial goals, risk tolerance, and investment horizon. Regular portfolio rebalancing is crucial, as successful mid-cap stocks may graduate to large-cap status over time. In conclusion, mid-cap stocks offer a compelling proposition for investors seeking a balance between growth and stability. They provide opportunities for significant returns while maintaining a level of established business practices that can help mitigate risk. Small-cap stocks, high risk, high reward. Explained. Small-cap stocks are shares of companies with a market capitalization typically between $300 million and $2 billion. These are smaller, often younger businesses that haven't yet reached their full potential. Think of them as the underdogs of the stock market, full of promise and ready to grow. Now, you might be wondering, why should I invest in these smaller companies when I could stick with well-known, established brands? Well, that's where the potential for high rewards comes in. Small-cap stocks have the ability to grow at a much faster rate than their larger counterparts. Let's look at an example. Imagine investing in Amazon when it was just an online bookstore, or Apple when it was still operating out of a garage. Those were once small-cap stocks that grew into the giants we know today. While not every small-cap stock will become the next Amazon, many have the potential for significant growth. But remember, with great potential comes greater risk. Small-cap stocks are often more volatile than large-cap stocks. They can be more sensitive to economic changes, have less financial resources to weather downturns, and may lack the established track records of larger companies. Take the case of a small biotech firm working on a groundbreaking new drug. If the drug gets approved, the stock could skyrocket. But if it fails clinical trials, the stock might plummet. This level of uncertainty is part of what makes small-cap stocks both exciting and risky. So, how can you navigate this high-risk, high-reward landscape? First, it's crucial to do your homework. Research the companies thoroughly, understand their business models, and keep an eye on industry trends. Look for small-cap stocks with strong fundamentals, innovative products or services, and competent management teams. Diversification is also key. Don't put all your eggs in one small-cap basket. Spread your investments across different sectors and companies to help manage risk. Consider balancing your portfolio with a mix of small, mid, and large-cap stocks. Another strategy is to invest in small-cap mutual funds or ETFs. These allow you to gain exposure to a variety of small-cap stocks, managed by professionals who specialize in this area of the market. It's also important to have a long-term perspective. Small-cap stocks can be more volatile in the short term, but over time, they have historically outperformed large-cap stocks. Patience can be your greatest ally when investing in these potential growth stories. Remember, small-cap investing isn't for everyone. It requires a higher risk tolerance and a willingness to weather market fluctuations. But for those who can stomach the ups and downs, the rewards can be substantial. Think about some of the most successful companies today. Many started as small caps. Microsoft, Netflix, and Tesla were all once small-cap stocks. While past performance doesn't guarantee future results, these examples show the potential that lies in the small-cap market. However, it's crucial to approach small-cap investing with caution. Don't invest money you can't afford to lose, and always consider your overall financial goals and risk tolerance. Small-cap stocks should typically make up only a portion of a well-diversified portfolio. As with any investment, staying informed is crucial. Keep up with financial news, company reports, and market trends. The small-cap market can move quickly, and being well-informed can help you make better investment decisions. How market cap influences your investment strategy. Market cap, simply put, is the total value of a company's outstanding shares. It's calculated by multiplying the total number of shares by the current stock price. But why does this matter to you as an investor? Understanding market cap is essential because it helps you categorize companies and assess their potential risks and rewards. Let's break it down into three main categories: large cap, mid cap, and small cap stocks. Large cap stocks, typically valued at $10 billion or more, are often established companies with a long track record of success. These giants of the business world, like Apple or Microsoft, tend to offer more stability and lower risk. They're less likely to experience dramatic price swings, making them attractive to conservative investors seeking steady growth and reliable dividends. However, don't mistake stability for stagnation. Large-cap companies can still provide substantial returns, especially when they tap into new markets or introduce innovative products. Their size and resources often allow them to weather economic storms better than their smaller counterparts. Mid-cap stocks, usually valued between $2 billion and $10 billion, offer a balance between the stability of large caps and the growth potential of small caps. These companies are often in a phase of expansion, making them appealing to investors looking for a mix of growth and value. While they may be more volatile than large caps, they can also offer higher potential returns. Small cap stocks, typically valued under $2 billion, are where you'll find many up-and-coming companies with significant growth potential. These smaller firms can be more agile and responsive to market trends, potentially leading to rapid expansion and impressive returns. However, they also come with higher risk, as they're more susceptible to economic downturns and market volatility. Now, how does this knowledge impact your investment strategy? It's all about diversification and aligning your portfolio with your financial goals and risk tolerance. If you're a conservative investor nearing retirement, you might lean towards a portfolio heavy in large-cap stocks for their stability and dividend potential. On the other hand, if you're young and have a higher risk tolerance, you might allocate more of your portfolio to small and mid-cap stocks for their growth potential. But remember, diversification is key. A well-balanced portfolio often includes a mix of all three categories. This approach can help you manage risk while still positioning yourself for potential growth opportunities across different market segments.